Dear ladies and gentlemen, our team is going to present the analysis on Luxoft Holding, a global provider of ITO solutions. We initiate coverage on Luxoft Class A share with a hold recommendation based on 12 months target price, representing 10.1% upside. Our natural guidance is driven by some favorable factors and counterbalanced by challenging drawbacks. Fragile position on the growing markets, ability to diversify in line with the threat of major contract loss, stable financial position with pressure on profitability margins, potential upside from M&A pipeline, and significant risk. We propose you to walk through these drivers.
Company was founded in 2000 in Russia, incorporated in 2006 under the laws of British Virgin Islands. It had been operating as a private company until its IPO in 2013 in New York Stock Exchange. Currently, Luxoft has delivery center primarily in Central and Eastern Europe, where a proportion of wages and professional skills of employee is one of the most attractive among regions, and provides IT solution to multinational company in USA and Europe. Such business model, combined with effective workforce management, allow Luxoft to keep market-leading position by revenue per employee ratio. Luxoft provides IT solution in 4 industries: financial services, which is a mature company vertical, fast-growing automotive and telecom, and also healthcare, which was recently launched through acquisition of Insys Group in 2016. Domain practices and modern technology for various industries are united within Luxoft Digital.
Revenue of Luxoft is driven by client industry's expenditure on IT services, and it is projected to significantly grow in the future, while global IT spending is showing little overall growth of 4.3 CAGR during 2017 and 2021. Disruptive technologies are driving the dynamics of IT market, and Luxoft is represented in almost all of them. Expertise in artificial intelligence, IT security, or automotive safety will play the role of Luxoft competitive edge in the future. Global IT outsourcing market is characterized by tough competition. To figure out Luxoft market position, we decided to distinguish strong traditional leaders with huge market share and high reputation from innovative niche players. We have conducted cluster analysis based on revenue, EV, and beta metrics. After that, we applied business analysis to outline the closest peer group of Luxoft due to similarities in business models, vertical specializations, and financial performance. Even though Luxoft is represented on the high-growth market, company is less diversified and has average growth rates among competitors.
Since its IPO, Luxoft managed to demonstrate a solid results in sales, doubling them in the last 5 years. Until 2015, top 5 anchor clients of the company were responsible for 70% of Luxoft revenue. However, starting from this year, revenue outside of core clients started to grow intensively that improved the diversification of the company. However, even during this period, companies stay highly volatile towards the financial performance of its main clients. We have discovered that the top 2 clients of the company, Deutsche Bank and UBS, are constantly decreasing the percentage of purchased IT services in the structure of their budgets. To predict the revenue, we decided to split its performance by verticals and break into client clusters. We expect that each of the verticals of the company, except financial services, will experience a 2-digit growth. This way, by 2023, the company will be able to form a well-diversified product portfolio. Therefore, the question of Luxoft's success lies in its ability to diversify effectively in line with keeping a stable relationships with its core clients. Intensive diversification of the company creates an opportunity to stabilize gross margin at the level of 39.4%. Indeed, as most of new contracts are signed under time and material basis, the reduction of fixed contracts allows company to reduce the effect of growth in IT wages. During the last 5 years, net income margin and EBITDA margins of the company declined significantly. The main reasons for such trend are additional upfront spendings connected with the involvement of new clients. In the future, we see this margin stabilize as the company grows and has some scale effect. Luxoft demonstrates a stable financial position. First of all, it has no long-term debt, and secondly, it tries to hold a significant amount of its assets in the form of cash. Historically, 10 to 50% of cash is used in order to conduct this M&A activity. This has a significant influence on future company's performance.
And Luxoft management plans to continue its aggressive strategy over the next 5 years. That is why we distinguish such opportunity within traditional DCF analysis, which includes only the organic growth of the company and the real option estimation to evaluate the potential acquisitions. The three-stage discounted free cash flow to equity model was selected due to the absence of long-term debt going forward. The cash flows are predicted to grow at 21.6% CAGR over the growth period, which is approximately 5 times higher than the long-term growth rate. The cost of equity was estimated using the CAPM methodology. The equity risk premium was determined by implementing the reverse DDM to S&P 500 and adjusted on country risk premium, as Luxoft has high risk exposure to emerging markets. The specific premium of flow diversification was calculated through the multi-factor regression model. That is why in 2019, the cost of equity is projected to be at the level of 14.45% and will significantly decline to the terminal period and will stabilize on the level of 11.95%. Historically, Luxoft management planned to continue its aggressive strategy to achieve 3 main goals: to gain geographical presence, to enrich its expertise in new verticals, and gain new clients. That is why we estimated the extra cash flow through acquisition as real option and constructed the Monte Carlo DCF model based on 75 scenarios for each year during the growth period. We calculated the CFRE of each region and potential growth rates. Due to our estimates, the successful integration of new businesses would move our estimates close to buy recommendation. To validate our DCF estimates, the multiple valuation model was conducted. Due to our study approach, we have found that market is not efficient in the days of Luxoft report publication. So we decided to ensemble our result by 50% weights. So we calculated the EV to EBITDA to show the historic performance of Luxoft, EV to employees to show its future performance, and the PEG ratio to estimate its future outcomes. We weighted them equally, so the gradual drop in 2018 would be compensated by the growth of workforce efficiency, which ensured our whole recommendation.
And moreover, comparing Luxoft to peers, its current business position can be associated with a number of risks that represent different potential impact and likelihood. Particularly, we identify 3 major risks that support our recommendation. The client concentration represents a major risk for Luxoft. Despite diversification strategy, Deutsche Bank and UBS, that represent financial services industry, are signed under highly unfavorable conditions for Luxoft, and they have an opportunity to terminate a current agreement in any given time without any obligation to the company. To consider this risk, we constructed tornado analysis. The other risk is related to the possibility of recent and new M&A management failure. For instance, recent acquired businesses insist and Interpro are expected to have at least a 30% miss in earning plan in 2018. Even though in long-term period an acquiring company tend to show a high growth dynamic as Excellion, in short term their performance is still hardly predictable. The final significant risk we identify is the possibility of minority investor interest deterioration. IBS Group controls approximately 82% of voting power. Therefore, according to New York Stock Exchange legislation, Luxoft is considered as a controlled company. And moreover, Luxoft residency in British Virgin Islands allowed them to use a low-level transparency procedures. By overall corporate governance estimating using ISS rating method, we identify the moderate threat to shareholders.
To summarize, Luxoft operates in the industries with high growth expectations. However, company's market position is fragile. Although company has a strong ability to diversify at a fast pace, there are still strong risk of crucial client relationship loss. Stable financial position in the future makes it an attractive asset, but currently Luxoft experiences pressure on profitability margins. Although there is a favorable potential for aggressive expansion, the investment risks are significant. Luxoft is driving towards success, but they still need time for their road construction. So, hold a minute. Thank you for your time. We are open to your questions.
Thank you very much for this presentation. I have a question in respect to cost of equity calculation. You applied country risk premium, as you mentioned. Which country risk premium did you apply?
Well, the most emerging markets that that Luxoft is represented at are the Russian market, Polish, and also Romanian. So we also have implying the relative volatility coefficient to estimate the present position of these markets. So you may see that for such market as UK, which is also has a high risk, we have also implied the country risk premium, as it is going to be the Brexit in the future years.
Yeah, my question was, which countries did you include? Those where the company sales are made, or where it is incorporated, or which country?
The countries where our clients generate the revenue.
Okay, I have another question. Well, your company has very strong M&A, and in your slide you say that margins were down because of M&A integration and so on, but then they improve. Have you considered the risks and what would be the consequences if future M&As would be also a problem for the company?
Yeah, so as we see historically, EBITDA and net income margins, they decline, and the main reason for that are additional upfront spendings that the company do in order to involve new clients. And those spendings, they mostly include some, for example, additional trainings for your staff, or for example, doing some operational processes and improvements in the new acquired companies. And in the future, we think those margins should stabilize as we look for historical evidences. A lot of M&A of Luxoft, they show some kind of drop in their future performance, although on the long run, they go to a stable level, and therefore they become profitable for the company. And therefore we are confident with our EBITDA and net income margins predictions.
And as we estimated the M&A performance through the real option, we can include as a risk-neutral measure the synergy effect, which can decline EBITDA margins and both gives them the increase. And also this effect was demonstrated through the risk-neutral distribution of normal and airline distributions.
And was the real option positive in intrinsic value?
Yes.
Yeah. How much does it add to the valuation?
Plus $10.53.
Okay.
My question is about the segments of the company. So you mentioned that it clearly has a vertical serving various types of the market. And that's probably the reason for how they target the M&As. But so my question is, did you consider, does it make sense to maybe value these segments separately and then do some of the parts valuation, or there are some across the company multiples that doesn't make sense?
Well, the company don't give the consolidated information about each vertical, so they have the expertise in both directions. For example, the blockchain can be realized in any of these verticals. So company don't deal to create some separate valuation of their verticals.
Yeah, so if you look at the company information the company provides to us, we can see what revenue each vertical generates, although we do not know what are the margins for those verticals, and we do not know what cost goes with it. So therefore, we decided to come up with our method.
And as for M&A, we have included some scenarios which included 3-4 verticals to, was the synergy effect of the combinations.
Okay, I have a question. Your company has the largest revenue per employee ratio, and the employee is probably the largest cost item for the company. So why do you think the margins of the company are lower than many of its peers? It should be more profitable than if it generates more money.
Well, we have found that the margins of the company are on the average market level. We don't think that they are lower. So operating cash flow margin. You may see the operating cash flow margin is during all the historic period was higher than its peers and even in their major competitor EPAM. And we think that it was the effect of the great employee policy that shows that it was the highest among its peers, but even higher than the giants of the market. I mean, Accenture, Cognizant.
Yes, and to add to this, we should understand that Luxoft has a significant amount of fixed contracts in their structure, which means that the companies, they pay upfront to Luxoft, and they do not connect their spendings on wages with the project on itself. And this opportunity of significant amount of fixed contracts enables company to have these margins that are pretty high.
And from the market position, Luxoft has really great quality of employees, because due to the Luxoft business model, most of them are situated in the Ukraine and Russia with higher education. And also, one more evidence that Luxoft operates its employees effectively is that company has the lowest attrition rates among its competitors and also high utilization rates, which means that the time of its employees is spent effectively.
And from the risk part, we consider to compare the Luxoft wage structure to the market. And according to Bank Inflation Risk Estimation, can you please show the appendix? We show the equally of this distribution, of this shown distribution. So the key conclusion that we are confident about maintaining the gross margin of Luxoft due to possible wage inflation.
And what is more interesting about margins, due to the last quarter results, the company has also given such information that now the lower bound of their margins in any project would be 36%. So now company would, we hope that company would well, develop their margin even higher.
You have such amazing presentation and hold recommendation. My favorite question always when I hear hold. If I'm portfolio manager who does not currently has any stock of Luxoft, what can I do with your recommendation?
You shouldn't buy them. Well, our hold recommendation can be, well, changed in the future when the company would conduct better M&A policy and would receive some results in the next 2 quarters, we hope.
Yeah, so basically we are waiting for the next quarter results, and there will be annual results for Luxoft, and we are looking for some upside numbers for their key clients like Deutsche Bank and UBS, and in case having those, our recommendation could be changed.
And also would like to add that the company must to maintain the policy of diversification structure. That means that the outside of top clients must grow intensively than the core clients and then control clients.
And from the market position, if company will manage to outperform its peers in the nearest time, it may influence our recommendation.
However, if you are the investor that is interested in the startup companies in the IT services or ITO, you may see that only Luxoft is fairly valued on the market now. EPAM, Globant, and other companies are a bit underperformed. So, well, we have conducted the reverse DCF to each company to show if its growing temps are higher or lower than expected for its fair price. And also the PEG multiple show if market is fairly valuating these companies.
Well, so if you're a portfolio investor...
Time is up. Thank you.